Jim, turn to you first. Are they going to cut in July or not?
More than likely. I mean, that's certainly the signal they've sent between the monetary policy report last week, the appearances from Powell in each of the previous 2 weeks. So I think they've pretty much laid the groundwork here. I mean, obviously, the employment report was pretty solid, but they're worried about the trade-related uncertainties hanging over the economy. Inflation is very muted. They've clearly given us the signal that they're going to go, probably by a quarter point.
So the future of the rally, then, is hanging on this?
Well, I don't think
every word, move, and everything else from the Fed.
I think everyone is a little bit fixated about it, but for good reason, which is that the market expectations for the Fed's rate cut are extremely important. But at the end of the day, it's going to turn out to be about earnings and about what's going to take place over the course of the next, really the next quarter or two. And we think the market expectations are simply too high right now for earnings. If you look out to next year, we're talking about 11% earnings growth, whereas this year, we're just trying to hit these incredibly low bars of like 1% or 2%. And that's what the bond market is telling you. You have lower expectations. And so, we're waiting for the Fed because that's what they need to keep equities higher.
So you're negative stocks?
Yeah, we just actually reduced on June 17th, we reduced our equity allocation to underweight by about 3%, which for us is a significant move. And we've also increased the quality of stocks that we want our customers to own, as well as to move money offshore, because that is where the biggest benefit of lower interest rates will actually be, not here in the U.S.
Where offshore?
Well, I mean, we like some of the Latin American countries. We like Brazil. We like a lot of the South Asia countries. We think valuation-wise, they're very attractive, and growth-wise as well.
Jim, the jobs numbers seem to give the market a little bit of an occasion for a rethink of maybe just how much is going to be behind a July cut or how dramatic the Fed easing is going to be. How much suspense do you think there's going to continue to be about exactly where we are in terms of what the Fed's expectations are, whether this is just going to prove an insurance cut or whether it's going to be necessary medicine?
Well, I mean, that's always the case. I mean, we're going to be constantly watching new data as they come in. And certainly at this point, there is some evidence of slowing. Even with that payroll number, the trend so far this year is a little over 170,000 a month, whereas last year was 220-something. So there's some moderation there. And meanwhile, I mean, the Fed is pointing not so much to the current numbers as the uncertainties related to trade, the fact that inflation is as tame as it is, to justify some easing. But the signal is that it's not dramatic easing. Now, that said, if the numbers start weakening significantly, that's a different story.
You're pushing against powerful forces, though, being negative stocks. It's not going to, even if the Fed moves once this month and you get progression on trade, those are absolute positives for stocks, no?
I would agree with you that they are positives for stocks over the longer term. What we look at is principally valuations, as really what's going to drive it. Let's put us back to where we were, let's say, last October and November. Everyone then at that point was worried about the Fed overshooting. Now what we're talking about is the Fed saving the day. What's really different about this economy versus that? And the answer is not very much. So what's happened now is rates have come down significantly, and then the question is, what is growth? And that's where I think valuations and portfolios have to really consider what they own.
Peter, where do you think the Fed ends up in the end of the month?
Well, they'll cut, but to Mike's point is, what would they do after? Is this the beginning of a rate-cutting cycle, or is this a one and let's play it by ear thereafter? And I think an important question is, what will it do? The bond market's already cut for the Fed. If you're buying a home, well, you just saw the average mortgage rate drop 75 basis points over the past year. You got 3 rate cuts if you're a home buyer. So what behavior is the Fed going to encourage by a rate cut that will help the economy? I argue that there's probably not going to be that much of an effect, but they're at least going to try and see what happens.
Does it affect the dollar?
I think the dollars are already weakening. I mean, the dollar index at 97, it topped at over 100 a couple of years ago. The dollar's fighting, whether it's its own worries about debts and deficits. But you look at the euro. The euro trades really well. When you look at all the issues that Europe has, and negative interest rates, and Lagarde now and going deeper into negative interest rates, the dollar has issues, and certainly rate cuts are not going to help.
This is a great question of what, Jim, cutting interest rates is really going to do, to Peter's point, and others have made it, whether it's Richard Fisher or others, whether it gets the stock market to go up but does little to spur corporate investment in other areas that would actually help the economy.
Well, there presumably is some feed-through from the equity market, the tone in the equity market, to business confidence in general, which does affect business investment. I mean, I think it would be a different story if the equity market was down 20% right now and the Fed had held stubborn. So I don't think there's any doubt that there is some pass-through from the equity market to the broad economy. And mortgage rates are down, but housing is actually up. When you look at the Q2 GDP numbers as they're adding up right now, and that's one part of the economy that looks like it actually picked up in the second quarter, the residential investment part, along with consumer spending. So, I mean, at the end of the day as well, I think you have to keep in mind that the Fed's not trying to get us back up to 3% plus growth. They would love that if productivity were soaring, but they're basically just trying to prevent the downside here, and they're happy with 2% growth, unless, of course, productivity is a lot stronger.
David, you suggest with this cautious stance on equities that, earnings forecasts probably have to come down, right? They look a little bit vulnerable going into next year, and the multiple maybe is going to have to adjust. But what about this premise that, a lot of investors start with says, look, if there's no recession, then usually you don't get big down moves in stocks that stay that way. I mean, is that legitimate or not?
Being underweight stocks doesn't mean selling stocks, right? And one of the things we advise clients to do is not to market time. If you missed 40 days over the last 10 years, you took your returns down by 10%. So you can't do that. But what you can do is actually decide where you want to be in the market. The Fed was originally in a posture to actually prevent us from dealing with a potential recession. That's not what they're doing now. Their policy has changed materially. And as a result of that, we're actually taking bullets that we might expend in a difficult situation, and we're spending them now to maintain the growth or some amount of growth in the future. That's not a particularly bright forecast. So I hear you, but if you have already made as much money as investors have made over the course of the last 8 to 10 years, you want to rebalance your portfolio now.
Jim, what do you make of the president's Fed nominees, and does that alter the likelihood of what the next couple of years of action is going to be?
Well, from what's known about them, they're certainly viewed as on the dovish side. I mean, they're not going to determine policy. I mean, even the St. Louis Fed research person's boss, of course, was on the dovish side already. So, I mean, they are leaning that way already in terms of dovishness. I don't think one or two other people, especially if they have different sort of frameworks generally, they're not necessarily going to influence people dramatically. But they add to the dovishness of the Fed right now. Again, do they mean the Fed's going to be moving aggressively without the economic numbers being weak? No. But they certainly will add to the Fed's dovishness.